Hi, we are going to look at a classification of financial assets in IFRS 9 today. This is not the entire standard. This is just classification of financial assets, a part of IFRS 9. This video should give you a very good overview about how financial assets are classified and what is the impact of classifying financial assets under a particular category. Before we go forward, let me quickly tell you why we need to classify financial assets under different categories. For any asset, there are three crucial periods from an accounting standpoint. One, when you buy an asset, you have to decide when you should recognize it in your books and what should be the value. Second, during every reporting period, you have to determine what should be the value of asset in the books. Is it going to go up? Is it going to go down? And what will be the treatment for change in value of the asset? And finally, what will happen when you sell the asset? These are the three crucial aspects. And what typically a standard like IFRS 9 tries to do is it classifies asset into two or three categories. In case of IFRS 9, it classifies asset into three categories. Let's say for example, it's A, B and C. And then what the standard does is it says what should be the treatment during these three crucial periods that we discussed about. That is, one, during initial recognition, what will be the treatment? Then during subsequent measurement, what will be the treatment? And then at the time of derecognition, what will be the treatment? It makes it very simple for us by classifying assets into these categories. So for example, I'm not going to tell you exactly what happens in the standard, but I'm trying to give you an overview, which will be very easy for you to visualize and what actually happens in the standard. So let's say for example, you buy an asset for $100. If you classify it under category A, the standard will tell you you can recognize entire $100 as value of the asset. Under category B, the standard may say you can recognize only 90. And category C, the standard may say you can recognize at 100. This is a very hypothetical scenario, and I'm just telling this for you to understand the standard. During subsequent measurement, that is at every reporting period, under category A, you may be allowed to keep the asset at the same price, that is at the purchase price of 100. Under category B, for example, you may have to see what is the latest fair value in the market. Let's say if it is 150, then you'll have to show the value of asset at 150, and there could be a completely different treatment for category C. You get the idea, right? The category or classification of financial asset will help the accountant, the entity, to decide how it should be treated during these three different periods. Moving on, IFRS 9. IFRS 9 classifies financial assets into three categories. 1. Amortized cost. 2. Fair value through other comprehensive income. And 3. Fair value through profit or loss. Do not think of these terms as complex. It's going to be very easy by the end of this video. I'll be repeating these terms often and you should be familiar soon with these terms. Moving on, I will walk you through each of the category. I'll tell you what are all the conditions an asset should satisfy to be classified under a particular category. I'll tell you what will be the accounting treatment at initial recognition, at subsequent measurement, and at the time of derecognition for each category. So that's how we are going to go. Finally, after I walk you through all the three categories, let's look at two examples. One, debt instruments, and two, equity instruments. Let's see when a debt instrument can be classified under these categories and what will be the impact. Similarly, let's also look at when an equity instrument can be classified under these three categories and what will be their impact. Let's move on. First of the three categories is amortized cost. If an entity wants to measure an asset at amortized cost, If an entity wants to classify a financial asset at amortized cost, it has to satisfy two conditions. So the first condition is called cash flow characteristics test. The second condition is called business model test. Under cash flow characteristics test, there should be some contractual terms. The contractual terms should, one, specify the dates. Dates of what? Dates of cash flows. And two, all these cash flows should be solely payment of principal and interest. Let me quickly repeat that for you to digest it. A financial instrument or a financial asset should have contractual terms. The contractual terms should say specific dates on which there will be cash flow, and these cash flows should only be repayment of principal and interest. The next condition is business model test. By business model, the standard means the entity's senior management's intention of what they are going to do with the asset. If an entity buys an asset, one, to hold and then to collect only the contractual cash flows, then it passes the business model test to be categorized under amortized cost. It will be easier if I give you a few examples and let's see whether these assets in the examples pass the two condition or pass these two tests. A simple example one, a simple vanilla loan. Let's say you borrow, let's say you lend money. Okay, we are speaking about financial assets. You lend $100 to your friend, and then there will be a 10% interest on this loan that you have given to your friend, and you want him to repay at end of the year, and which will be 110. Let's see if this financial asset, a receivable of $110 at end of 1 year, satisfy the two conditions under amortized cost. The first condition is, are there contractual terms that specify dates? Yes, we have got a contractual term of 1 year, and then it specifies dates of the cash flow. It specifies when your friend should repay the loan to you. And what is the nature of cash flow? What is the nature of $110 that you are going to get at end of 1 year? It has got two components. It has got a principal component of $100 and it has got an interest component of $10, and there is nothing else. So this contract passes the first test of cash flow characteristics test. The second condition, business model test. Here the business model will be your intention at the time of granting the loan. When you grant the loan, if you intend to just hold it in your books for the next 1 year and then collect $110, you pass the second condition as well. In this example, an asset will be classified as an asset held at amortized cost. Let's look at another example. What if there is an equity instrument? Let's say you want to buy shares of Google. What will happen to this financial asset after you buy? On a daily basis, the value of an asset, or in this case Google's share price, will fluctuate, and Google may or may not pay dividends, and the principal, the money that you spend to buy the shares, will be repaid only when Google is liquidated. So here this does not pass the first condition itself, that is, it does not have specific dates on which there will be cash flows. At the end of each year you may or may not have dividends, and also the second part of the same condition, the repayment are not just principal and interest, because if Google runs into a loss, you may never get your money back, and there is no guaranteed interest component in this deal. So the return that you will get from Google share is solely dependent on profitability of the company. Okay, there is just one more point that I want to tell you before we move forward on this. What will be the treatment for initial recognition when you classify an asset under this category? You can or you have to measure the asset at fair value plus transaction cost. So you'll have to find out what is the fair value of the asset. In a typical case, it will be the money that you have spent to purchase the asset, and if there are any transaction cost associated with the purchase, then that should also be treated as part of the cost. Let's move on to the other two categories, which will be very quick. I'll quickly tell you when an asset can be classified under these categories. The first of the other two categories is fair value through other comprehensive income. So here, let's look at whether the financial asset is a debt or an equity. Only a debt or an equity instrument can be classified under this. For example, if an asset is a derivative, it cannot be classified here. So for a debt instrument to be classified under this category, it has to satisfy two conditions. One, it should pass the SPPI test. That is, the repayment or the cash flows should be solely payment of principal and interest. And the second condition is simple, it should not be classified under category 3, that is fair value through profit or loss. Second, equity instruments. Equity instruments at the option of the entity can be classified under this, meaning an entity may classify an equity instrument under this category if it wants to. So it's totally up to the decision of the entity. And initial recognition for an asset under this category is same as amortized cost. You find out what's the fair value, recognize it, add the transaction cost, that will be the initial recognition value for an asset held as fair value through other comprehensive income. Moving forward, the last category under IFRS 9, fair value through profit or loss. For specific type of financial assets, there is a mandatory classification for an asset to be classified under fair value through profit and loss. The example is one, a derivative, and then an instrument with an embedded derivative. These two investments or these two assets should be classified as fair value through P&L. There is no choice. And 3, if you buy an asset for the purpose of trading, that is, you buy an asset to sell it back in a very short period for profit, then an asset or that asset should be classified under this category, fair value through profit or loss. So let me quickly recap. 3 types of assets should be classified under fair value through profit and loss. There is no choice to the entity. This is a mandatory classification. If an asset is a derivative, if an asset has got an embedded derivative component, and 3, if you buy an asset for trading purposes, for short-term profit-making purposes, then an asset will be fair value through profit or loss. In case of debt and equity instrument, an entity has an option. An entity has an option to classify an asset through profit or loss. Okay. So to quickly recap, we saw there are 3 different types of classifications available for financial assets. There are certain cases where it is mandatory for an entity to classify an asset under certain categories, and there are cases where it is optional for an entity to classify an asset under certain categories. And certain categories needs some conditions to be met before it can be classified there. To make this more clear, let's look at 2 important types of financial assets, debt instruments and equity instruments, and see when we can classify a debt instrument under these 3 categories, what will be the impact to the company. We'll also look at when equity instrument can be classified under these categories and what will be the impact to the entity. So the first one, debt instruments. So I want you to have a very clear mind. This is going to be relatively simple. I just need you to concentrate. Okay. Both debt and equity instruments. Okay. We always have an option. It is always available for an entity to classify this under category 3, fair value through profit and loss. So what we are trying to say here is any asset can be classified under this category, fair value through profit and loss, and this classification is irrevocable. That is, at the time of initial recognition you decide whether this debt instrument should fall under fair value through P&L, and if it falls under this category, then you do not have a choice to reclassify it into other categories. 2. If a debt instrument passes the two conditions, cash flow characteristics test and business model test, then it can be classified at amortized cost. 3. If a debt instrument passes the first condition, cash flow characteristics test, and an entity does not choose this option, that is an option to classify an asset at FETPL, then an entity can classify an asset under fair value through other comprehensive income. And finally, if all the three conditions are not met, the default classification will be fair value through P&L. Let me quickly recap. You can classify an asset under fair value through P&L. There is always an option. But if you choose to classify an asset here, then you cannot change it for rest of the life of the asset until you sell it. If your debt instrument passes these two conditions, it should be classified under amortized cost. If a debt instrument passes only the first condition and you do not classify it as FETPL, then you can classify it under fair value through other comprehensive income. And this is a residual category. If none of the above three happens, then you have to classify it under FETPL. This is something that I want to mention to you. Take a typical example of housing mortgage loans. The person who borrows the money always has got an option to prepay the loan. Whenever there is a prepayment, the bank or the lender should reassess the instrument and see whether it passes both the conditions, cash flow characteristics test, business model test, and only if it passes the two conditions, it can continue to be classified at amortized cost. Okay. Why do we have to worry about all these classifications? Because classifications will determine what will be the accounting treatment for this assets. So what will happen if you classify an asset under this category? Let's look at it. Initial recognition. Initial recognition is when you buy an asset, you decide what should be the value of the assets in the book. So for example, if you buy an asset for $100 and then you incur $10 more as transaction cost. For example, in this case, if it is brokerage charges or processing charges, what will be the accounting treatment? For simplicity, let's assume your purchase price is fair value. If an asset is classified under amortized cost, it will be fair value plus any transaction cost. So in this case, it will be 110. If an asset is classified under category 2, again it's the same, you can measure it at 110. But if you have an asset that is categorized under fair value through profit and loss, then you have to measure it only at fair value and any transaction cost will be charged to P&L. So this is the difference. Moving on to subsequent measurement, that is at end of every reporting period, what will be the accounting treatment? Any interest income that you earn from the asset will go to P&L. It is same for all the three categories. Any interest income will go to P&L under all the three categories. The second most important thing is change in fair value. Let's say you have lent money to a person or lent money to a company and whose credit grade has degraded. you think the company might default, then what happens? The value of the asset, the fair value of the asset actually goes down. What do you do now? Okay, if you classified an asset under amortized cost, then there will be no impact. You just ignore the change in fair value. If you classify the asset under fair value through other comprehensive income, then as the name says, you move the impact to other comprehensive income. And 3, if you classify an asset under fair value through profit and loss, any change in fair value goes to the P&L. So for example, if you classify, let's say the value of a reduction in fair value is, let's say, $20. Okay, you think the asset that you bought for 100 is now worth $20 less. In this case, you would have bought the asset and incurred $10 transaction charges, adding up to a total of 110. The fair value of the asset today is only $80, 100 minus 20, but you do not make any changes to the fair value or the book value of this asset if it is classified under amortized cost. If it is classified under category 2, fair value through other comprehensive income, the change in fair value, this should have been 110, pardon me, the change in fair value, that is 110 minus 80, which is $30, in this case it is a loss, should go to other comprehensive income. It will not impact your P&L. If it hits your other comprehensive income, it will directly go to your reserves. So what happens in this case is, your company's equity reflects the change in fair value of the assets, but it will not impact your profit and loss for the period. Moving on, if an asset is classified under category 3, fair value through profit and loss, any change in P&L, that is in this case negative $30, will directly hit your P&L and you will see the volatility in your profit and loss account. Moving on, impairment. IFRS 9 speaks about something called expected loss model. It is a separate topic in itself, so I'm not going to dig into it now. All I want you to remember is, if an asset has got impairment, IFRS 9 uses an expected loss model to calculate value of the impairment. It does not only reflect what is the reduction in value as of today. In this case, it will not just look at $80 minus 110, which is typically $30, but it will also look at what is the future loss of this asset and then add that component, and the total will be the impairment number here. It is the same as amortized cost for fair value through other comprehensive income. In case of assets held at fair value through P&L, there is no impairment, because you are already recognizing the asset at fair value. Finally, derecognition. Derecognition is when you sell an asset, any gain or loss goes to P&L. It is the same for an asset held under category 2, fair value through other comprehensive income, and it's the same for 3, fair value through profit or loss. So derecognition is same across all the 3 classifications. Moving on, equity instruments. So we started off with how or when you can classify a debt instrument under the 3 categories. What will be the initial recognition, subsequent measurement, impairment, and derecognition treatment under the 3 categories for debt instruments. Now let's do the same for equity instruments. For an equity instrument, it's relatively very simple. At the time of initial recognition, you look at whether you bought it for trading purposes. If you have bought it for trading purposes, then it is mandatory for you to classify it under fair value through profit or loss. That is the 3rd category. If it is not, then you have an option to whether put it under fair value through other comprehensive income or fair value through profit and loss. It's relatively a straightforward approach. The accounting treatment for equity instruments under the three categories should be relatively easier because you have already gone through the accounting treatment for debt instruments. You cannot classify, you must have already noticed that you cannot classify an asset under amortized cost. So this is completely out of the picture. So you don't have to worry about it. There are only two classifications. Initial recognition is same as what you saw in debt instrument. It is transaction value plus transaction cost. In this case it will be 110 and in this case it will be 100 as per our previous example. Subsequent measurement, all dividend will go to P&L. Here also all dividend will go to P&L. Any change in fair value will go to OCI. Any change in fair value will go to P&L. So you must now realize that the accounting treatment is similar for the categories irrespective of the asset. So if you classify an asset under any particular category, the accounting treatment is going to be unique for those respective categories. Finally, impairment, again we'll have to go through the expected loss model. There will be no impairment in fair value through profit and loss. And here derecognition is the most unique part for a equity instrument in IFRS 9. Any profit or loss at the time of derecognition cannot be transferred to P&L if an asset is classified as fair value through other comprehensive income. So in our earlier example, we bought an asset at $110. At end of the first year, we saw the value of asset went to $80. So there was a negative $30 in the reserve. Let's assume now at end of second year, you've decided to sell the asset. The share price has significantly gone up. Let's say it is at 200. Then the profit or loss in this transaction will be 200 minus 110, which is $90. This $90 cannot be moved to profit and loss. This $90 will directly go to other comprehensive income and ultimately to your reserves. In case of a fair value through P&L asset, the treatment is similar to debt. Derecognition gain or loss goes to P&L. So that is a very high level overview of classification of financial assets under IFRS 9. I know it could have been confusing in some areas, but if you go through them again, it should be quite easy for you. This is relatively a much more simpler model than IAS 39. I hope you enjoyed the video. Let me know your thoughts in the comments below.